Corporate Finance PowerPoint presentation. In this presentation, we will discuss forecasting objectives. Get ready, it's time to take your chance with corporate finance. Forecasting objectives. When thinking about forecasting, we're thinking about into the future. We're thinking about kind of like a budgeting or projection type of process. We want to plan ahead, making changes in strategy as needed. So we're going to think about what we think will happen into the future so we can strategize now and do what we need now in order to accommodate what we believe will be happening in the future based on our best guesses, based on our forecasts. We're going to construct a financial plan to support growth. So we're hoping that the growth is going to be in the future. We need a financial plan in place so that we can support that growth. A firm's plans must take into account the risk-taking desires of the people in charge. So when we're thinking about a company, obviously growth potential, or we're thinking about what's going to happen into the future, we have to take into consideration how much risk somebody wants to take on when pushing into the future. We've discussed, and we will discuss, leverage type of ratios, how we could finance growth with debt or possibly equity financing. And whenever making those types of decisions and whenever thinking about something that's going to happen in the future, which we don't know what is going to happen, we have to be balancing out risk and reward, oftentimes thinking about the idea that, of course, the potential for greater reward, greater profits, comes along with greater risk. The ability to hedge against risk with sound planting. So whenever we're thinking about risk, we don't want to think about it and just say, well, I'm gonna just go for it and take on a lot of risk because I think there could be benefit with regards to that risk or related to it, even though risk and reward are kind of tied together with the decision making to some degree. In other words, the more profits that you might be able to accumulate in the future could come along with increased risks. We want to make sure that we're taking measured risks that are going to be within the desires of the owners of the companies. So pro forma statements are what we're going to be putting together for our forecast, basically budgeted financial statements that we're going to be putting together. Remember that the financial statements tell us where we stand at a point in time, the balance sheet, and how we did over that time period, the performance of it, the income statement. So we want to project into the future what we think is going to be happening into the future, meaning how do we think we're going to perform, which is going to be a pro forma income statement. Where do we think we're going to stand at the end of that time period, the pro forma balance sheet in essence. So it's going to help the company estimate things like the receivables, the inventory, the payables, the profits, any borrowing that's going to be needed is going to be something that we're going to be using these pro forma statements for. They're often something that's going to be requested by a bank or lender. So if a company was looking for a loan or something like that, then the bank or lender is going to want some plan into the future. What do you need this loan for? What do you predict that's going to be happening in the future, and why? That typically will start out with a pro forma or budgeted financial statements. So systems approach to developing pro forma statements. So how would you put together then the budgeted financial statements? We can use a systems approach, which typically will start with the creation of the income statement, because that's going to be the performance statement. So if you think about how would you put together where you think you will be and what your performance will be in the future, like a year out into the future, well, you can think about the starting point of where you're going to start. That's the balance sheet as of now, right? The balance sheet as of now is where you are at. That's where you stand. The income statement is how you did last year, right? So if you think about the balance sheet now, we can then think about, well, how far are we going to go? What's the distance that we're going to be going? That's going to be like the income statement, like how many miles did we drive in an hour or something like that. We could think about how far did we get from A to B into this time period, which is a year in our case, meaning how much revenue and expenses did we generate over the year's time period. So we'll put together the income statement, which will measure that, how far we went, revenue and expenses type of income statement. To do that, though, we're going to need to be making sales projections and the production plan. So to put together an income statement, we got to think about how many sales we think we're going to make. If we're producing things, then we have to think about how much we need to produce in terms of inventory, or if we're buying inventory, we need to think about how much we're going to be purchasing in order to meet the sales projections. So the first thing we need to do typically, what's going to be our sales, how many are we going to sell? Then we can use that information for our production plan if we're making things, to then calculate what we're going to need in terms of materials, labor, and overhead. Or if we're purchasing inventory, we can think about what purchasing needs to be for our sales needs. And then we can construct the cash flow budget, which is going to be different from the income statement, which is on an accrual basis. So then we're going to have to take the income statement, kind of break it down into a cash flow statement, because obviously cash flow is going to be important as well. So we're going to have to take a cash flow statement, and then we can construct the pro forma balance sheet. Remember, what the balance sheet is where we stand as a point in time. So after we got our performance statements, meaning how far did we go, how far did we drive in a mile, in an hour, like if we were driving a car and we're trying to see how far we got in an hour, then we could take the balance sheet and then say, okay, well, where did we start at? What was the odometer at the beginning? What was the balance sheet at the beginning? How far did we go, income statement, or how many miles did we drive in the hour? And then where do we stand at the end of the time period, or where do we expect to be standing? That's going to be the ending balance sheet that we'll be putting together, or the pro forma balance sheet. So it looks something like this. We'd say, okay, we're going to start off, if we're going to try to think about putting together our pro forma or projected financial statements in the future, first thing we got to do, we have to do it in this order. We got to think about how many sales we're going to have, right? If we don't know how many sales we're going to have, we can't have any idea of how far we're going to go. We're trying to estimate how many, like if we're doing the miles thing here again, how many miles did we drive? We're going to have to know the sales in order to figure that out. So we need the sales projection first, and then we can do a production plan. So once we have the sales, if we make inventory, then we can put together the production plan. We need the sales in order to know how much we need to produce. So if we're going to make inventory, we have the items, components of inventory being materials, labor, and overhead. So now that we know what our sales are, we can start to figure out how much material we're going to need, labor, and overhead for it. Or if we're purchasing inventory, if we sell inventory, we can then think about how much we're going to need to purchase, basically, that we're going to resell on inventory for a retail type of company. And then once we have that, we can put together the pro forma income statement, which is our performance statement. How far are we going to go? Now, obviously, when we put together the pro forma income statement, we're going to need more than just the sales and the production plan, basically the cost of goods sold. We're going to need the other income items, but notice that the other income and expense items are usually more straightforward, because they're not going to be dependent on, they're not going to change with the sales volume. So when you're looking at like selling and admin type of expenses, those are typically going to be similar from year to year, because they're more fixed costs oftentimes. Like sales salaries or administrative salaries are typically more fixed and whatnot. So then in any case, we'll put together the income statement. Now we also want to have the cash budget that we're going to have to put together. We'll put together the cash budget using other supporting budgets like capital budgets. If there's any large capital expenditures that we're going to be making, for example, we're going to have to determine what those type of expenditures will be, because those will not be on the income statement, because if we're buying property, plant, and equipment, it's going to go on the balance sheet as an asset, and then we'll need it on the income statement when we depreciate those capital purchases. So we're going to need it, and that'll give us our cash budget that we're going to be needed. Then we also are going to have to take into consideration the prior year balance sheet, so that we can then calculate the ending balance sheet. So this is where this is our ending point. So notice where we're starting with. We're basically kind of, if we're doing our driving a car in an hour type of scenario, we're basically thinking about, let's pretend the odometer's at 0 and just see how many miles we drove. That's going to be the sales projection, the production plan, and the income statement to see how far we went, right? How many miles we drove. Then we're going to be considering where we started, the beginning balance, what was the odometer at the beginning, so that we can then add to it, how far we went, so that we can then have our ending balance that is going to be our projected balance for the balance sheet at the end of the time period. So we'll break this out in a little bit more detail as we go forward.